from Powell, Tom, and what does it mean for your outlook for stocks?
Well, Powell gave tough on inflation talk. It's been consistent with the Fed's stance for all of 2022. So I don't think it should be a surprise to investors. But I think one of the takeaways for me is the Fed is going to really respond when inflation is on a trajectory to be under control. And that pace is unknown. It's something the Fed doesn't even want to attempt to forecast. And of course, because the markets are nervous and don't have visibility, they assume it's going to be around for a long time. I think this is where people who are constructive on markets should really focus on. The drivers for rising inflation or accelerating inflation have essentially evaporated. Housing inventory levels are now at the highest, almost approaching to where they were during the great financial crisis. Durable goods like cars and furniture, which became Veblen goods for a while, as the prices rose, demand rose, they're now turning into no demand even as prices fall. So I think you have outright deflation in durables. And then even on the subject of wages, we look at some of these high frequency measures like job openings from Indeed.com labs, they're down more than 40%. Wage growth doesn't have to get down to 0 to meet the Fed's inflation target. They're being pretty explicit. It needs to fall about 1.5 percentage points in terms of wage growth. So if it's running around 3 to 4% is consistent with actual overall inflation of 2. So unless someone thinks inflationary drivers are accelerating, I don't think the Fed is sitting here wanting to crush asset markets. But they do want to remind people they're not going to be easy. And again, I think the stock market takes its cue from the bond market. The 10 years really kind of been pretty stable. I think this sell-off is going to end up being bought.
Yeah, unless you think, and there is, at least in small corners at the moment, a belief that inflation is going to be more ingrained into the system than some people think, for a variety of reasons. It's the story that Nick Timros of the Journal wrote the other day. Geopolitics, protectionism, only increasing global demand for commodities, wages, and because of the job market that don't really go down all that much, the demand for housing, et cetera, around the globe. Are you considering that at all, or you sound fully dismissive of that view?
I wouldn't say I'm dismissive. I think they're all credible points. But at the end of the day, the alchemy is, what is the shakeout in terms of consumer expectations for inflation? And the UMich surveys already show now for the third consecutive month, it'll be the third final, inflation expectations are falling, both on the 1 year and 5 year. So despite everyone's claim that inflation is even getting stronger, from a consumer's perspective, it's weakening. And look at the market-based measures of inflation. So if you look at the swaps market, the 1 year forward's at 2.7. It's pretty much been pinned there since mid-June. I don't think that the inflationary sort of outcome of all of these factors is actually accelerating inflation. I think it's cooling. I can't say I know where inflation is going to be in 12 months, but I would say that it seems like it's being on the downside versus consensus.
So Farmer Jim, who's sitting next to me, Jim Lebenthal, said 50 in September, 25 after that, and 25 after that. What are your own expectations? Because I need to know that in order to discuss your year-end target, which is lofty for the S&P.
I think between now and year-end, I think the Fed is going to do somewhere between 100 and 125 basis points of tightening. That's kind of on track with their explicit targets. So it could be 75 in September and then 25 in the 2 meetings after that. There's, I think, a misconception that just because the Fed is raising rates, markets have to fall. It really depends on how much is priced into market expectations already. And again, I think that's something we've been focusing on. If you look at the rates markets, it's already priced in the Fed being pretty aggressive into year end and actually even staying pretty tight throughout 2023.
I know, but what happens if they send the economy as a result into a recession? You could cite any statistics you want that say, well, stocks can go up when rates go up, but these are unprecedented times. It's so many respects that do you actually think that they can raise interest rates as much as Powell leads you to believe they will today, and at the same time the economy doesn't go into recession, thus then the stock market doesn't fall out of bed in any great way either?
Great question, Scott. S&P's peak to trough was down 27%. So it's already discounted at that point close to a 90% probability of a recession. I think the question people have to ask themselves is the contour of incoming data painting a picture where this recession's either unfolding faster or bigger, or are things holding up better? I think we've seen a lot of evidence this is turning out to be a soft landing. Now, there is some softness because a lot of durable goods had basically a pull through because shortages and double ordering. And you look at used cars, I mean, that's, that's crashing just as quickly as, potentially as quickly as the stay-at-home stocks crashed. That's not a recession. That's an adjustment of demand. In fact, it's actually a disinflation, so it's a benefit for consumers. So I think that there are, again, like you said, a lot of mixed currents, but the market's priced in a recession. I think a soft landing, to me, still seems more probable.
Josh Brown, you have a question for Tom Lee, I'm told?
Yeah, Tom, I'm going to read this sentence from what Jerome Powell said today, and I'd love to get your take on it. Quote, history shows that the employment costs of bringing down inflation are likely to increase with delay as high inflation becomes more entrenched in wage and price setting. Our aim is to avoid that outcome by acting with resolve now. End quote. That really sounds like the hammer. And that really sounds like the labor statistics are about to get like a lot worse, and maybe those 11 million fake jobs that we've been talking about being out there don't really exist in a world where money actually costs something. Venture capitalists can't raise $1 billion just for getting out of bed, et cetera. What do you think about that statement, and what might the implications be into year end?
Josh, that's an important statement. Powell's not just talking about the labor report itself having to show softness. That's a communication statement to employers, to be cautious on hiring. Once you do that, if you, like you're saying, if you take the number of open jobs down from 11 to something smaller, and companies slow expansion plans, that doesn't necessarily create a recession. That actually really helps slow and reduce wage inflation expectations. That's exactly what the Fed wants. So I think that statement's actually appropriate. It really fits where we are in the labor markets, but it doesn't mean that they need unemployment rates to actually soar to 5, 6, 7%. It does mean we need to get wage growth down. It both comes from both employers' hiring plans and then individual expectations. And as we know, a lot of the growth in the employment market for the last 2 months has actually been multi-job holders. Single job holders actually have been declining for 2 months. It's not a great labor market as it is.
Hey, Tom, you think that you say I am more confident of greater than 4,800 on the S&P. So that's 700 points higher from here. And you're not ready to give up on 5,100. Can you get there without the idea and the belief by the market that the Fed is going to pivot? Because I don't see how you can.
Scott, it's a great question. It's difficult for bullish views to sort of seem credible on days like today. But keep in mind, two things that were sources of inflation surprise in 2022, the biggest contributors. One was used cars, and the second was travel. Now, most people think, oh, well, it'll stop contributing to inflation, so it'll go to zero. Remember, these are core items. They're part of core goods and services. Used cars could actually start subtracting from CPI in as early as next month. And travel, especially airfare, could actually be deflationary into the rest of this year. That means we could actually see significant undershooting of inflation. Already the swaps market's looking for less than 2% monthly inflation annualized into year end. It could have some zeros and negatives into it. That would change how markets view what the Fed has to do, and it's going to prove again that the market's done a lot of the work for the Fed by keeping financial conditions tight.
I want to give you Jim Lebenthal's next to me here to my left. I want you to give you a chance to respond, engage on somebody who's in your camp.
He said something
and
worried me.
it's hard to find a lot of people who are as bullish as you see the picture over the next 4, 5, 6 months and beyond.
I feel like I'm doing a lot of defending myself, and I don't think that's the right way of doing it. What I'm trying to do is say, here is the data that I'm looking at, whether it's the economic data on inflation or, more importantly, what I'm seeing and hearing from company reports. Having said that, Tom just gave me a piece of data that actually troubles me a little bit, where he says that at least based on Indeed.com, the number of job openings are going down. And I heard what Josh said about fake jobs. Or fake job offerings. That's been out there for a while. I'm trying to juxtapose that with a Wall Street Journal article from 2 days ago that said that basically what we know, right? The reason the continuing jobless claims levels are so low is because people get laid off and they find a new job, right? Amazon warehouse worker gets laid off, they go across the street to the airport and get a baggage handler job. And by the way, the pay raises are continuing in that context. So, Tom, to you, I mean, I'm troubled by what you're saying, because really what you're saying is you need to see wages come down, and that Wall Street Journal article is saying they're going the other way. What are we hoping for? I mean, I know we're in a good news is bad news environment. I'm telling you, good news is good news. Am I wrong?
Jim, I think that there's a lot of math that people throw out, and I just want to point out where some of the math was historically. Wage growth today, average hourly earnings is growing at about 5%. If you look at the entire period when core CPI or PCE, whatever you want to use, was running around 2, by the way, only 29% of all years since 1950 have been under 2.9%. So, I mean, it's a pretty unrealistic target. Wage growth was around 3 to 4%. That's roughly 3.5%. The Fed doesn't need wages to fall. They just need the job market to soften enough so wage growth slows to around that 3.5% level. That's how you get to the Fed's target. So I think what's really important is that can be achieved by the job market collapsing, but it could be achieved by everything you pointed out, making it harder to switch jobs, openings pulled, confidence about wages and demands for higher wages weakening. These are things that could happen, and it's part of the Fed's communication. I mean, I think that the statement Josh made is good. It sends a chills to employers. It sends a chills to anyone, looking and reading and wanting a job. It's going to make people think twice about switching. Look at what's happened with housing already. I mean, housing is in a pretty big downturn. It's not going to suddenly start rising again just because someone thinks there's a Fed pivot. We're already in a downward cycle for housing. That's really the last leg of what you need to cool core inflation.
Tom, we'll leave it there. I appreciate your time so very much. We'll see you soon. That's Tom Lee of Fundstrat joining us today. When we come back, tech is taking